We start by answering the question, what are carbon credits? Carbon credits allow the owner to emit 1 ton of carbon dioxide, CO2, or its equivalent in other greenhouse gases, GHGs. Companies that exceed their emissions limits must purchase carbon credits, while those that emit less can sell their excess credits to others. The carbon credit system operates primarily through a cap-and-trade model. All these concepts are described briefly in this lecture. In summary, carbon credits are a vital tool in the fight against climate change, enabling companies to manage their emissions while promoting a market-based approach to sustainability. As the global focus on reducing greenhouse gas emissions intensifies, understanding carbon credits and their mechanisms becomes increasingly important. Carbon credits are essentially permits that allow the owner to emit 1 ton of carbon dioxide, CO2, or its equivalent in other greenhouse gases, GHGs. The concept is part of a broader strategy to reduce global emissions and mitigate climate change. Companies that exceed their emissions limits must purchase carbon credits, while those that emit less can sell their excess credits to others. Carbon credits play a crucial role in global efforts to combat climate change by encouraging emission reductions. They provide a financial incentive for companies to invest in cleaner technologies and practices. Creating a market for sustainability. By putting a price on carbon emissions, they help to create a market for sustainable practices and innovations. There are 2 main types of carbon credits. Compliance credits. These are used in regulated markets where companies are required to adhere to emissions limits set by governments. Voluntary offsets. These are purchased by companies or individuals looking to offset their carbon footprint voluntarily, often through projects that reduce or sequester emissions, such as reforestation or renewable energy projects. The carbon credit system operates primarily through a cap-and-trade model. It concentrates on emission limits which in turn dictate the trades and market dynamics, especially in high fuel-consuming industries. For emission limits, governments set a cap on the total amount of GHGs that can be emitted by all participating entities. This cap is reduced over time to encourage lower emissions. Companies that reduce their emissions below their allotted cap can sell their surplus credits to other companies that are struggling to meet their limits. This creates a financial incentive for companies to lower their emissions. The concept of market dynamics is explained through the argument that carbon credits can be traded on various exchanges, and their prices fluctuate based on supply and demand. New regional markets are emerging, and existing ones are evolving, driven by regulatory changes and public pressure to address climate change. Efforts to address these concerns and build a high-integrity market include the widespread adoption of robust, third-party standards, such as those developed by the Integrity Council for the Voluntary Carbon Market, ICVCM, and the Voluntary Carbon Market Integrity Initiative, VCMI, and the potential for new technologies like blockchain to enhance transparency and traceability. Ensuring quality in the future of carbon credits requires a multifaceted approach centered on rigorous standards, independent verification, and enhanced transparency. Key strategies focus on evolving the market from a buyer beware system to one where high-integrity credits are clearly labeled and highly valued. By adhering to rigorous standards and embracing transparency, the carbon market is evolving to become a credible and effective tool for financing meaningful climate solutions. The future of carbon credits involves significant growth, moving toward stricter regulation, greater transparency, driven by tech like AI/blockchain, and higher quality standards, transforming them into a more credible asset class attracting investors, though challenges remain with market fragmentation and low-integrity credits. The global carbon credit market is expected to witness a compound annual growth rate of 39.4% from 2024 to reach $4,734.35 billion by 2030, making them a more credible asset class attracting investors, though challenges remain with market fragmentation and low-integrity credits. Carbon credit markets are evolving, emphasizing quality and integrity including ratings and transparency. Tackling double counting with robust rules and balancing compliance versus voluntary needs, all while aiming to deliver real emission cuts, foster climate finance, and support net zero goals, though they're not a silver bullet but a crucial component. Key trends show higher quality credits fetching premiums, growing demand for carbon capture, and ongoing governance challenges for effective global climate action. Technology Education and Mentoring Center stands committed to the worldwide efforts for reducing emissions to save our environment.